So, I mean, they've handled Fed interest rate hikes. Is it your sense that we are near peaking, or that there's a fair bit more to come, more than one more hike to come?
I think the more important question is to ask ourselves, are risk assets of corporate bonds and equities overvalued? And our perspective is, no, it is not overvalued, because these risk assets have already adjusted to what we call the risk-free or the discount rate, which had moved from like 0 to 5.5% over the last 15 months or so. So if you kind of look at it that way, and the guidance from the Fed is that probably another 1-2 more rate hikes, it simply tells us that it's a good time to be engaged in risk assets. For example, investment grade bonds, which are really pretty low in terms of historical default rate. You are clipping coupons of 6%. So when you construct your portfolio, investment grade must be featured as an income generator.
Okay.
And then on the other side of the portfolio, buy into what we call secular growth companies. So the companies that kind of ride on this secular theme, especially the theme of the world becoming a digital economy. So big tech is featured there as
which I know TVS, of course, is very, very big on digitalization, as it were. We were talking to an earlier guest who was concerned and thought that the first cycle of cuts by the Fed could start as early as, before the end of the year, while markets are pricing maybe early next year. And the reason he's thinking that cuts could come before the end of the year is he's worried that there could be another bank blowing up, small regional U.S. bank. And the reason for that is because, the Basel III rules are only going to apply to the big guys, the top 8, not to these small fellas, which are going to leave them still fragile and still vulnerable. What do you think?
Yeah, there could be some idiosyncratic risks lying around that even probably the Federal Reserve is not aware of. But as we have seen in first half with the failure of a couple of regional banks, they are not systemic in nature. So, in terms of the impact on the broader market, stock market, corporate bond market, I think it's going to be quite minimal, even if there is a case like what we have seen in first half.
So even for the Fed, even if another small regional bank does blow up, it's not going to be enough to push them or tip them to start cutting rates as early as before the end of the year?
That would be one of the considerations, obviously, to kind of make them slow it down somewhat, the trajectory of rate hikes. But I think, given that, they have done so much in such a short period of time.
500 basis points,
exactly.
Wow,
I think the full impact of that has not been fully felt in the real economy. We shall see that going forward. Inflation has already peaked out. So I think that probably is the more important consideration. Hence, a much slower, trajectory of rates in terms of timing, in terms of the magnitude of it, and that actually is a very good backdrop for risk assets.